All right, let's talk about asset location. And this is different than asset allocation. Asset location has to do with making your investment portfolio more tax efficient. A lot of the big law attorneys that I work with have high tax rates as a high focus area, high priority, and trying to minimize taxes any way we can. And one thing people don't realize is that your investment accounts and even your bank, like your savings account at your bank, they actually can add to your taxable income for the year and potentially cause problems for you. You know, the larger your investment accounts are, the bigger an impact they can have. So it may not be an immediate concern in a lot of cases if you're just getting started with saving. However, the issues can build up over time, and the more that you prepare your investment portfolio in advance, the easier it is to maintain the tax efficiency. So, in order to understand asset location, we need to take a step back and get some basics about the different types of investment accounts and then the different types of investment taxes associated with them. So, let's start with the types of accounts. In general, there are sort of three broad types of investment accounts. There are taxable investment accounts. These are just ordinary brokerage accounts. There's no contribution limits. There's no minimum time frame for which you have to keep your dollars invested. It's just a regular investment savings account, and it's color coded orange. It's not bad. It's liquid and it has a lot of flexibility, but there's a lot of good things about it, particularly earlier in your career, earlier in your life. But as your investments grow and you need to start living off of your investments, some of these other accounts may be more attractive. So then there are tax deferred accounts. These accounts are things like your 401k at work, where you can put pre-tax dollars into the account, or a pre-tax IRA, known as a traditional IRA. A lot of the people I work with don't get all the benefits of a traditional IRA. So for purposes of this video, I'm going to sort of use tax-deferred accounts and your 401k interchangeably, but the focus is tax-deferred accounts. There are multiple different types. I'm generally going to be referring to 401ks, but there are other types of tax-deferred accounts. And then Roth accounts. So you may have the option to contribute to your Roth account in your 401k. And then there's also Roth IRAs, and many of my big law clients make too much money to contribute directly to Roth. But there are strategies to get dollars into the Roth accounts. You can look at the video on backdoor Roth IRAs. And so I've color-coded this green just because these dollars are tax-free when you take them out for qualified withdrawals. And then these dollars you get a benefit up front, but you don't get a benefit later. The contribution limits to IRA accounts are lower than contribution limits to 401k accounts. So this isn't necessarily just Roth IRA. It could be Roth 401k. But in general, what I'm trying to convey is that your Roth accounts typically are not going to be as large as your tax-deferred accounts, like your pre-tax 401k. And your taxable account will probably grow to be fairly large over time because 401k accounts and Roth IRA accounts have contribution limits every year. You'll fill these two buckets up, and you should be saving considerably more into your taxable investment account in addition to those. And so this one typically grows to be the largest. So let's talk about the way they're taxed. I've touched on this for every one, but just to be clear, a taxable account, any of the interest or the dividends or capital gains, like gains on your investments, if you recognize them, like if you sell an investment at a profit, or you receive a dividend, or you receive interest from bonds, that's all taxed in the year that it happens. So you're taxed now. That's not all bad. It's a really flexible account. You can put as much as you want into the investment account. There's no contribution limit. You can take your money out whenever you need it. Hopefully you're saving for the long term, but if you have a short-term goal, this is also a fine account to use because there's no minimum holding period. Tax-deferred accounts, you save on taxes now, but you pay taxes later. So think about your pre-tax 401k account at work. If you contribute dollars to that 401k account, those get deducted from your income and you don't pay taxes on those dollars, which is a nice benefit. If you're in a high tax rate now, 32%, 35% federal tax rate, it's nice that if you contribute money to your 401k for savings, then you're going to save that tax rate on those dollars. Roth accounts are never taxed again under current law. I just have to say that because it's possible that they could change the law and tax you, but I don't see any reason that that would happen. So here you don't get an upfront tax benefit, but as long as your withdrawals are qualified, then you're never taxed again. Now, for both of these accounts, in general, you have to wait until age 59 and a half to access the dollars. There are exceptions and nuance to the rules, but just generally speaking, you should, in your head, think, I get tax benefits for these accounts because I have to wait before I access the dollars without taxes or penalties. Here, I'm not getting a tax benefit, but I can use it for whatever I want. So this is a good time for me to give the traditional disclosure. You got to consult a tax advisor. I am not a tax advisor. This is not tax advice. I'm a financial planner. This is not investment advice, tax advice. This is just education. But I think it's going to be really useful for you, and I hope you get a lot out of it. Okay, so that was the different types of investment accounts. And now I want to talk about the taxes that can be generated from your investments themselves. And to talk about that, I'm going to pull up what's called a Form 1040. This is the summary page of your tax return. So if you filed your taxes for calendar year 2022, you can go look at the PDF that was, your CPA sent you, or if you filed online. It should be one of the first pages there. It's like the cover sheet of your tax return that is a summary of all of your taxes. It'll have your name, your social. If you have any dependents, it'll list them here. And then what I'm highlighting here is it goes through all the various components of your income. So if you are a salaried BigLaw associate, you get a W-2 form every year where your company is telling you and the IRS how much money you were paid in salary and bonus. And that's what this big number is right here in box 1A. If you're a partner, you get paid differently. And so your income from K1 distributions, partnership income, may be down here on line 8. But what I want to highlight for you is that, see, all these different rows are all things that can be additive to your income or even adjust your income later on, such that you get to row 9, this box 9 right here, and this is where you add all those things up and you get your total income. Then below that, there are some adjustments and deductions, and then you get your taxable income. But the point I want to make is above line 9, all these different things are things that add to your taxable income for the year. So it's not just your salary or your distributions or your bonus, but it can be things like from your investments. So look at rows 2 and 3. Here they're calculating, or they're showing tax-exempt interest. This is stuff that would come from your investments. Taxable interest, this would come from your investments. Qualified dividends from investments. And ordinary dividends from investments. So what I want to convey to you is that your investment accounts can add or not to your taxable income every year. And this is one easy way, sort of low-hanging fruit, to mitigate your overall tax burden every year by being smart about how you hold your investments and what you invest in and all that sort of stuff. It's technical. What I'm about to explain to you is technical, and it may not be something that you're ready or willing to implement on your own. But if you're paying a financial advisor to manage your investments, they should absolutely be doing what it is I'm about to illustrate for you. So let's move over to the different types of investment taxes, and I may hop back and forth between this screen and that form. So first, interest. So back on the Form 1040 that we were looking at, I want to talk about your taxable interest. It's line 2B. Taxable interest is taxed at your ordinary income tax rate. That's like your federal marginal income tax rate. So if you're at the 32% bracket or the 35% bracket, that is how your interest is taxed. Interest comes from bonds and also from banks. So for the first time in like 15 years, we can all earn a decent yield on bank savings. Like maybe you got a high yield savings account with a 5% interest rate. Understand that 5% interest you're being paid is going to be taxed at your ordinary income tax rate. And for some of you, that's a very high rate. And I'm going to come back to this in a little bit. Next is ordinary dividends. So going back to our 1040, that's this box here, ordinary dividends. These are dividends that are typically paid by small U.S. companies and or foreign companies. And they, again, are taxed at your ordinary income tax rate, whatever your marginal income tax bracket is. Short-term capital gains. So these would show up on the 1040 under capital gains or losses here. And they would be detailed on Schedule D if you want to go look at that. Those also get ordinary income tax rates. And what they are realized profits on an investment that you held for less than 1 year. In general, there are exceptions to this. I'm really just talking about stocks, bonds, mutual funds, ETFs. I'm not talking about real estate or options or derivatives or other non-stock bond type investments. But generally speaking, short-term capital gains are taxed at your ordinary income tax rate, which, as we've been saying, can be fairly high. Qualified dividends, this is in yellow because these traditionally get long-term capital gains, which is usually lower than your ordinary income tax rate. These are paid by larger companies and some foreign companies. So back on the tax return, qualified dividends are right here. And then, of course, there's tax-exempt interest, which is what it sounds like generally, where you're not taxed on it. There are exceptions to this with the alternative minimum tax and other nuance, but generally speaking, this is a nice thing to have. But qualified dividends, those are taxed at long-term capital gains rates. And then long-term capital gains. These are profits on investments that have been held for greater than 1 year, and they get taxed at your long-term capital gains rates. And again, just talking about stocks, bonds, mutual funds, ETFs, not talking about other types of investments. So, the highest possible tax bracket on these items right now is 37% federal for ordinary income, and then 20% federal capital gains rates for long-term capital gains. So you can see there's a pretty big difference in the top tax rate. These are the 2023 maximums. I am not saying that you are subject to these tax rates. I don't know your particular tax situation. I'm just saying that these are the top highest marginal rates for these different categories. So you may be subject to lower rates, but in general, ordinary income in red is going to be higher than long-term capital gains in yellow. All right, so let's start putting these two things together. We're back where we have our taxable account, tax deferred, and our Roth account. And let's go back to that 5% high yield savings account that I was referencing a couple minutes ago. This is high yield, HYSA, exclamation mark, high yield savings account. Getting 5%, that's awesome, super exciting. People haven't seen those kind of interest rates in 10, 15 years. I know from experience that a lot of my clients are really excited about it. But I want you to be aware of how that savings account can impact your taxes and whether it's actually the best option for you. So let's just pretend that you're in the highest marginal tax bracket. Just for example's sake, you may not be. Apply your own tax situation or consult with a tax advisor. But for the purposes of the illustration, if you're in the 37% federal marginal income tax bracket, your 5% is going to be taxed at 37%, and your net after-tax interest is going to be 3.15%. So the 5% that you are paid on your high-yield savings account is going to go right here to taxable interest, and it's going to add to your income, and you're going to be taxed on that income. I think, from my experience, many people don't realize that and are not aware. And understand also that if you're in the 37% federal marginal tax bracket, you're probably going to pay things like the net investment income tax and supplemental Medicare tax. And this also isn't including state and local taxes. So if you're in New York or California or in a high income tax place, your actual tax rate on this might be over 40%. So again, consult a tax advisor, look at your own situation, look at your tax return, and just understand that this 5% high yield savings account is adding taxable interest to your overall tax burden. And so at the end of the day, you don't get to keep the 5%. You're going to pay taxes and you're going to have a lower net. Now, I'm not suggesting you save emergency cash in a tax deferred or a Roth investment account because you need this to be liquid. you don't want to put it in one of these accounts. But just for the sake of illustration, because these accounts are protected from current taxation, the 5% hypothetical yield that you're earning would suffer zero taxes, and you'd keep the full 5%. So again, don't put your emergency savings in your 401k or your IRA or anything like that, because you can't access it for a long time. But just understand for illustrative purposes that if you have some investment, maybe it's not your high yield savings account, maybe it's a bond investment or a stock investment, it's some long-term investment, a 5% interest or a 5% yield or a 5% return does a lot better in these tax protected accounts than it does just in your traditional taxable account. Okay, so I hope I haven't made you feel bad for having a high yield savings account. What is an option for you? Well, one option is to consider tax-free municipal bonds or a tax-free municipal money market fund for your taxable investment account. So what happens is states, local municipalities can issue bonds called municipal bonds. They may be backed by projects or revenue like taxes or like the local NFL football stadium revenue or toll roads, whatever it may be. And their interest is generally tax-free. It's not always tax-free. You have to consult a tax advisor. But generally, it's tax-free. And it can be tax-free at the federal as well as the state level. So again, if you're in a high income tax state like New York or California, you'll be able to find funds that own just California municipals or just New York municipals. And so they'll be exempt from both federal and state taxation. These bonds know that they are tax-free, and therefore they pay a lower interest rate. So the trade-off is you can either go get a 5% taxable, lop off whatever you're going to pay in taxes to get what your net is, and if you go compare it to your tax-free municipal, call it, say, like a money market fund, it may be higher. You may wind up accepting the lower yield for the tax-free municipals, and it winds up being a higher yield or a higher return because you're not having to pay taxes. And this 5% hypothetical yield gets cut down by your taxes, and you may do better with the tax-free issues. Okay, I want to take a little side trip here and talk about ways in which adding taxable income through your investments can be a huge pain for you in other ways besides just the obvious addition to your taxes. A second ago, I was saying that your municipal bond yield may be more than your high yield savings account yield when you account for the taxes on the high yield savings. Well, what if you run into a situation where your tax-free municipal money market yields 3% and you do the calculations, and if you go to a high yield savings account and pay the taxes, you get 3.15 in our hypothetical illustration. You might say, well, I'm still doing better. I'd still rather have the 5% high yield savings account because even after the taxes, I'm doing better than I would do in the municipal bonds. I would really encourage you to hold on and wait. And the reason is sometimes you can lose tax credits and or deductions just by virtue of your overall income. And so it can be more painful than just focusing on the return of the investment itself. I'm going to use the child tax credit as an example, but I don't want you to think that if you don't have children that what I'm saying to you doesn't apply to you, because there are a wide variety of tax credits and tax deductions and things. And all I'm trying to illustrate is adding to your taxable income, even if you do a little bit better on the investment itself, adding to your taxable income can have a domino effect in other areas of your taxes and wind up being not a good deal for you. So using the child tax credit as an example, in 2023, you might be eligible for a tax credit, reducing your tax bill by up to $2,000. This is different than a tax deduction. A tax credit just dollar for dollar reduces how much you owe in taxes. So you could get up to $2,000 per child. Well, importantly, it depends on how much money you make, whether you qualify. So once a married couple earning $400,000 or more once a married couple starts earning $400,000 or more, the amount of credit they can get starts being reduced. $2,000 starts coming down. And by $440,000, it goes to zero and you get no tax credit. If you're single and you make $200,000, but you have a child, you can start losing this $2,000 tax credit. So imagine a scenario where, let's say you're married filing jointly and you have 2 children. If your household income is right at $400,000, and just for illustrative purposes, let's say you have $50,000 in taxable interest coming off of, I don't know, $1 million in a savings account. I know it's an extreme example, but to make the point, now your $400,000 in taxable income is increased to $450,000 because you've earned 5% in interest in your high yield savings account. Now you've phased yourself out completely from the $2,000 per child. So you've lost $4,000 because you have 2 children. You could have gotten $2,000 in tax credit per child. But because your income has gone from $400,000 to $450,000, now you've lost the $4,000 in tax credit. And if you go back and look and determine it's because I went for an extra 0.15% in yield in my savings account, you might be really frustrated by that. And so I would encourage you, my rule of thumb is that if the yield on a tax-free municipal bond, mutual fund, ETF, money market fund, or just the bond itself is comparable to a high yield savings account, I would prefer to go ahead and accept it and not increase my taxable income from my investment accounts, because you can have spillover effects like this that impact you in other ways. And it may not be obvious, but it's something that can definitely happen, and you need to be aware of it. All right, so let's talk about the way to allocate efficiently to the various buckets, the different types of investment accounts. So as a reminder, taxable investment accounts, dividends, interest, all that stuff passes through the account to your tax return every year and is taxable to you in that year. Tax-deferred accounts, you save on the taxes now, you'll pay them later. So these shelter dividends, interest, capital gains, all that stuff from taxes until a later date. Roth accounts, they shelter them basically for the rest of your life, assuming that the law doesn't change and your withdrawals are qualified. So let's talk about how to allocate. So Roth accounts, you want to put your highest growth stuff. So if you have a diversified portfolio of investments that includes stocks and bonds and maybe other things, you might have some high growth stocks, you might have some more conservative stocks, you might have some high yielding bonds, and you may have some conservative low yielding bonds. You want to take that overall portfolio and segment it, and you want to put your highest growth stuff here, because the way to take the most advantage of never being taxed again is to stuff as much high growth into this account as you can and not pay taxes on that growth later. For your tax deferred account, this is where you want to put your highest interest stuff, but not necessarily high growth. And the reason is you're not being taxed on this stuff right now. So high interest is shielded from taxation right now, but you are taxed on it later. And so as you take money out of this tax deferred account, you're going to pay taxes on those dollars, and you don't necessarily want it to be to having had capture like the highest growth over that time frame. And then finally, your taxable investment account. This is where you want to put your most efficient stuff, most tax efficient stuff. And it's also where you want to keep your liquidity, because you can't get short-term needs out of these types of investment accounts. These are earmarked for retirement later. This is where you need to have liquidity for short-term goals, that sort of stuff. So what are the most efficient, tax-efficient investments? Well, it's the qualified dividends that get taxed at the lower capital gains rate. And it's short-term bonds that not always, but are generally the more conservative, lower yielding, more liquid types of bond investments that you could use for shorter term goals. Again, I'm recording this in August of 2023, where short-term bonds are actually higher yield than long-term bonds, but that is an unusual circumstance. And generally speaking, short-term bonds are the more conservative, lower yielding when we look over history. Okay, so let's put it all together. Let's pretend that you have an investment portfolio that is 70% stocks and 30% bonds. This isn't one single investment account. This is the combination of all of your accounts, your 401k account, your Roth IRA account, your pre-tax 401k account. This is your entire household's investment portfolio. And let's say you're targeting 70% stocks, 30% bonds. Within the stock range, the kind of darker blue, you're going to have different types of stocks. You might have U.S. large companies. That's the L, not a C. You might have U.S. mid-size companies. You might have U.S. small companies. That's the USS. You might have developed international stocks, which would be things like Western Europe, Japan, Australia. And you might have emerging market stocks. Those are things like China, South America, Latin America, Eastern Europe. So you're going to probably have a diverse array of different types of stocks. You also might have different types of bonds. You might have some high interest bonds that are more aggressive, and you might have some low interest bonds that are more conservative. And we need to think about, okay, here's my overall investment portfolio pie. I can actually split this up into component parts to be as tax efficient as possible. My overall portfolio is going to stay 70% stocks, 30% bonds. I'm not messing with the allocation. The asset allocation is going to stay the same, the 70% stocks, 30% bonds. What I'm going to mess with is the location of the different slices of the pie. So we have our three accounts: Roth, tax deferred, and taxable. And what I'm going to do is I'm going to color code these and draw some arrows. So what I'm saying here is that U.S. large cap stocks typically pay qualified dividends. That's the most efficient taxation of investments that we have in our video. And so the U.S. large cap stocks are orange. They can go into the taxable account. U.S. mid-sized stocks, most of them, many of them, maybe not most, a lot of them pay qualified dividends. Some don't. And so a portion of your mid-cap stocks can go to the taxable account, and a portion of these mid-cap stocks that are expected to have relatively high growth, they can go to your Roth account in green. Small cap stocks. Fewer small cap stocks pay qualified dividends, so fewer of these stocks would go to your taxable account. And small cap stocks are expected to have the highest return among U.S. investments over very long periods of time, decades. And so we might earmark the rest of the small cap stocks for your Roth account. Developed international emerging markets, similar story. A good portion of developed international stocks pay qualified dividends. They can go to your taxable account. Then the rest would probably go to your Roth because they're expected to be high growth. Emerging market stocks, fewer emerging market stocks pay qualified dividends, so there's less orange here. More of them are expected to be high growth, but not receive qualified dividend treatment. They go into your Roth account. Low interest bonds. This is your liquidity bucket. It's all going to be earmarked for your taxable investment account in orange because they're not paying a high interest, so it's not suffering as much from ordinary income taxation. And these are typically your more conservative bonds that you might use for shorter term goals and liquidity. So this is earmarked for your taxable account. And what's left are your high interest bonds. These are the bonds that suffer the most from taxation, but they are bonds. And so their overall long-term growth profile is not as high as stocks. So these would be earmarked for your tax-deferred accounts. You would take this slice and put as much as you can into your tax-deferred accounts. So typically the way this happens is you kind of have to prioritize. And remember that there are contribution limits every year for IRA accounts and for 401k accounts. And so these that are kind of mixed bags, maybe you say, okay, my developed international stocks, I would like to earmark for, let's say, my Roth account first. But after that gets filled up, the rest of it can spill over to my taxable. It's not going to spill over to my tax deferred. It's going to spill over to my taxable. Emerging market stocks, maybe I want to put those in my Roth account first, and then any spillover goes to the taxable because it's never going to be perfect, and there will be spillover between the accounts. So it's not always going to be just a perfect puzzle that gets put together and you only have one type of investment in each type of account. But what you're going to do, and you should start doing early, is you're going to build the base as best you can so that later in life, as your investment portfolios grow and the taxes that are kicked off of them, or the income, the interest, the dividends, You don't have to start moving things around later and potentially cause taxable events. So just understand that this is like a utopia perfect scenario, and there will be spillover between the accounts. So you just prioritize what you put in first, and then all of the spillover winds up going to the taxable investment account. All right, so let me dive into an example, just a hypothetical example that a big law attorney might experience. Let's pretend that you're in the 32% ordinary income tax bracket at the federal level. So this isn't including your state income taxes if you have them, your local taxes if you have them. It's not including the net investment income tax or other things. We're just looking at your federal income tax bracket. And let's say that you're in the 32% ordinary income and 15%, excuse me, you're in the 15% for your long-term capital gains tax bracket. What I typically find, almost always, is that there's no asset location being done, and maybe you have a 70% stock, 30% bond portfolio. So your taxable investment account has 70% stocks, 30% bonds. Your 401k at work, your tax-deferred account, 70% stocks, 30% bonds. Maybe that's done through a target date fund. And your Roth account, if you're doing backdoor Roth IRA, 70% stocks, 30% bonds. I want to pause and say this is not going to bankrupt you. If this is what you're doing, do not feel bad about it. It is fine. It isn't as absolutely efficient and optimal as it possibly could be, but it's not going to bankrupt you, and don't feel bad about it. Continue doing what you're doing. I'm just illustrating a way that it can be made even more optimal. If you were to apply asset location, your overall asset allocation, the allocation between stocks and bonds, would stay the same. You're 70-30, 70% stocks, 30% bonds. It would remain 70% stocks, 30% bonds. But hypothetically, one way that you could allocate the stuff is to do your Roth account at 100% stocks. Your tax-deferred account, like your 401k at work, might be only 10% stocks and maybe 90% bonds because you've put your high-interest bonds in this account. You've prioritized high-interest bonds for this account. And you've prioritized the high-growth stocks for this account. And then your taxable account might be 80% stocks and 20% bonds. This might hold your qualified dividend stocks like U.S. large cap, some mid cap, and some small cap, maybe some international, depending on the spillover from these. And then it might hold 20% in low-interest bonds that are relatively conservative and can be used for liquidity needs if and when you need it. This is a way that you would apply asset location. It's just hypothetical, but just to illustrate and bring it home that typically what I see is people will arrive at a target asset allocation and they'll go apply it to each of their accounts. That's fine. It's not terrible, but this might be the more efficient way to get it done. All right, I was alluding to this on the previous screen, but I want to give a warning now. Does asset location have the potential to save you money on taxes? Yes. Will it consistently offset a 1% asset management fee that an advisor might charge you? I don't charge this. I do charge an asset-based fee, but it's not this high. The answer is no. So if you've seen this video, if you're watching this video and you're thinking to yourself, oh my gosh, I'm not doing this. It sounds too complex. I don't think I can do it. I have to go hire an advisor and pay him 1% to do this. No, absolutely not. This can save you in taxes, but I don't believe it can consistently offset the 1% asset management fee. If this is the only reason that you would consider hiring an advisor, then I don't think it's worth it. I would just go back and do the regular asset allocation and not try to apply the tax location stuff that we've talked about. I want to educate you about it. I think you could do it and apply it if you wanted to, but if you're not comfortable with it, you don't need to, and you don't need to pay an advisor strictly for this. As your account values grow, the impact of asset location is bigger and bigger. But if you're just starting out, it's really not going to kick off a lot of dividends and interest and capital gains that are super meaningful in terms of taxes added, but it will grow over time. And I do think that building the right base early is the better way to go about it. But understand that if you're going to hire an advisor, don't hire them just because of this kind of technical wizardry. hire them because a variety of other reasons. I'm a financial planner. Investment management is an optional thing for my clients. They can manage investments on their own. It's one of, call it 8 categories that we deal with, among other things. So if you hire an advisor, don't pay them a 1% asset fee just for something like this. I don't believe it's going to consistently offset that. The way I think about it is that it's a benefit on the margins that a professional should be doing for you. But really, you should be paying an advisor because you aren't going to do the basics on your own. This is not a basic concept. This is a more advanced concept. If you're not going to do this on your own, that's okay. You don't have to. But if you're not going to do the basics, like getting your asset allocation right, making the investments, rebalancing, keeping your fees low, that sort of stuff, if you're not going to do that, then hiring an advisor is absolutely worth it. My analogy for this is hiring a housekeeper. If you hire a housekeeper and they dust your blinds, that's great. I'm glad they're doing that. They're a professional, and that is additive on the margins. But that's not the reason you hire a housekeeper. You hire a housekeeper because you want them to do the laundry, mop the floors, vacuum the carpets, that sort of stuff. You want them to do the basics. Whether they dust the blinds in your house is not really going to impact the overall cleanliness of the home. And whether you are applying asset location is not going to break or make or break your long-term wealth. You need to do the basics. If you're not doing the basics on your own, hire an advisor. If you will do the basics on your own, but you don't feel comfortable doing this, don't worry about it. You don't need to. It's just a benefit on the margins that a professional should be doing for you if you've hired them. All right, so in summary, asset location is just jargon for putting investments in the most tax-efficient account. That's all it is. It can be complex, and your specific tax situation matters. There's not a right way for every person. I've tried to give relatable examples for big law attorneys that I work with, but you need to consult a tax advisor. You need to consider your own situation, and it can help mitigate taxes on the margins. It's not going to make or break your wealth. Don't go hire an advisor because you feel like since you're not doing it that you need to pay somebody 1% to do it. It's helpful on the margins. It's not a reason to go hire somebody outright. You hire somebody if you're not doing the basics on your own. All right, hope it's helpful. Thanks a lot.